But at some point, there's going to be fallout from this. So just keep that in the back of your mind. And it's going to take years for them to prove it. And along the way, our bets were the EDA, Electronic Design Automation duopoly, Synopsys and Cadence Design Systems, and then the Fab Five, manufacturing equipment providers. Again, ASML Applied Materials, Lam Research, KLA, and Tokyo Electron.
Hey everyone, welcome back to Chipstock Investor. Today we have Intel earnings coming up for you, as well as two of our favorite wafer fab equipment companies, Lam Research and KLA Corp. First, we're going to talk about Intel and why the best way to invest in Intel in 2024 isn't by investing in the stock at all. Nick, kick us off with some earnings highlights.
Yeah, I feel like we're back to kicking Intel while it's down. The stock is actually up quite a bit over the last year. I think we just got a quarterly sell-off, but that was deserved. Their rebound is not happening like the market anticipated it would. So the high level numbers, revenue up 10% year over year to $15.4 billion to close out the year. GAAP earnings per share, which a lot of investors, I think, were miseducated in the bear market of the last couple of years as being real profitability. It's one profitability metric that you should definitely be familiar with. GAAP earnings per share actually, are positive again, 63 cents compared to a 16-cent loss last year. On an adjusted basis, nice rebound as well, as you can see from our little chart. But free cash flow still deep in the red at negative 2.1 billion. Full year 2023 free cash flow negative 14.3 billion. We're going to come back to this momentarily, but just if there's one takeaway from this whole video, it's free cash flow. You got to be familiar not just with GAAP earnings per share, but also free cash flow and all the ins and outs that count for the difference between the two. One of those, often overlooked note here, Intel, big mature business, riding a rebound, but not only are they unprofitable based on free cash flow, shares outstanding actually increased 3% year over year at the end of 2023. Big mature business, you would expect the share count to be decreasing over time. That's not happening at Intel. A lot of reasons why we continue to root for Intel. The world needs that more diversified semiconductor manufacturing base, but this is just not one that we find investable. Multiple reasons as to why. So high level financials from Q4. Let's talk about operational highlights.
Yes, this comes back to that Intel goal of 5 nodes in 4 years. Intel 4, which corresponds to the 7 nanometer manufacturing process node, is in full swing. Intel 3, or that's the 5 nanometer, basically a refined version of Intel 4 using EUV from ASML, as well as that Centura Sculpta machine from Applied Materials for multi-patterning EUV lithography, is also just beginning production, with initial products expected in the first half of this year. So, Nick, there's a lot of hype surrounding this goal, this 5 nodes in 4 years. Why is this not necessarily living up to the hype? Because they are making this goal a reality, right?
Yeah, you can see on the left here in this chart that Intel provides that the execution in getting these new manufacturing processes up and running. They continue to talk about how they are on track with that goal. And of course, all the hoopla in recent months being 20A and 18A, the A being angstrom. There's 10 angstroms to a nanometer. So that's where that comes from. Intel kind of shifting its manufacturing process names to the angstrom era moniker. There's some other things going on here that if Intel executes on these and not just gets these things in place, but actually starts winning customers for that 20A and 18A process node, there's some other things going on like their backside power delivery technology, and then also the gate all around, referring to the actual transistor, the way the transistors on the chip are actually manufactured. Lam Research and KLA, which we'll discuss later, big beneficiaries from this. The reason why this is not translating into big gains for Intel yet is because they're having to spend all of that money on semiconductor manufacturing equipment. So ASML, Applied Materials, Lam Research, KLA Corp, and Tokyo Electron, the Fab Five. That's where most of that money is flowing right now. So Intel getting lots of government subsidies to help with this manufacturing in the US, eventually in Europe with that big new Germany facility. We've zoomed in on Intel's map here, the big factory in Israel, the expansion in Israel, Southeast Asia, a multi-continent effort here, but tens of billions in CapEx, which is what you need to calculate free cash flow, tens of billions in CapEx and only billions in subsidies. Intel is going to have to spend a lot of money. And in the next few years, Wall Street analysts still don't think free cash flow is going to flip to positive on a full year basis. We don't think it's going to either. So a lot of issues going on here. That's, I think, stripping away some of the hype around the manufacturing. What about the AI? All this business with AI, Intel going down this bringing AI everywhere path in recent months.
Yeah, they've been talking about that a lot. But what we can really see from the company's financials is the story is not necessarily about AI, but it's really about a healthier level of inventory in the PC business, which is Intel's bread and butter. You can see that in the client computing group there this last quarter, 8.8 billion, which is up 33% from last quarter. So we know that that consumer market has hit a bottom. They expect some growth in that part of the business. Data center and AI, that second line item there on this chart, is still losing market share to NVIDIA. That's just the long and the short of it. It's down 10% from last quarter, 20% from last year. Network and edge, that is what's going to get defunded and eventually sold off as an entirely separate business, which Intel announced earlier in 2023. And that roughly corresponds to AMD's Xilinx embedded business. And then finally, as you can see, Mobileye, 637 million in the quarter, up 13% quarter over quarter, up 11% year over year. But that is going to begin to slump with the rest of the automotive industry in the first half of 2024.
Lots of puts, lots of takes for Intel. Let's maybe back up again, though, to Intel Foundry Service, IFS. They kind of hinted last year that they're at least internally going to separate the chip design business from some of their manufacturing processes so that IFS can go out there and strike deals with fabless chip designers, your NVIDIAs and your AMDs and so on and so forth. They have been announcing some agreements with customers, although they haven't announced a big customer acquisition by name yet. That's still waiting in the wings, but they're still touting this IFS growth. I think this is an important chart because a lot of investors are betting heavy on this IFS being the reason to invest in Intel over the long term. But you can see, yes, big revenue growth, but also with revenue growth, as you ramp this business up, of course, you're going to also have increases in losses as well. You got to spend the money if you want to expand a manufacturing facility, a manufacturing business until you reach a certain scale, until you reach a certain level, you're going to lose money. This is becoming increasingly apparent to a lot of investors. Take Tesla, for example, as they kind of go through another phase of ramping up their own manufacturing for Cybertruck and expand into new geographies around the world. It's kind of a similar thing here. IFS, yes, stellar growth, but increasing losses. This very well could be a great reason to invest in Intel over the long term. But again, Casey, for the folks that have been watching since we started this channel a year and a quarter ago, we've said all along, Intel is going to have to prove it. And it's going to take years for them to prove it. And along the way, our bets were the EDA, electronic design automation duopoly, Synopsys and Cadence Design Systems, and then the Fab Five, manufacturing equipment providers. Again, ASML, Applied Materials, Lam Research, KLA, and Tokyo Electron. All of those big government subsidies, great for Intel to help them ramp up what they want to do with their goals. But all of that government subsidy and then some going to directly flow out of Intel's coffers and flow directly into the revenue part of operations for the Fab 5 and others.
And of course, getting into the semiconductor making part of the industry is not cheap. It costs a ton of money. It's very complex. There is a rising cost to doing business. And so we really feel like until Intel splits into two, like AMD did a number of years ago, into AMD and Global Foundries, Intel just doesn't meet our criteria for investment at this point.
Yeah, that's the long and the short of it. Root for Intel, absolutely. It would be very healthy for the semiconductor industry if IFS becomes a robust business, but it's a distant third place to TSMC and Samsung. And there's easier stocks to own for the long term. There are a lot of great businesses that are riding that consumer electronics chip rebound, like Qualcomm, that have actually remained profitable throughout this downturn. And Intel's not cheap, even after we got this little 10%-ish sell-off after last week's earnings update. The stock trades for 45 times Wall Street's expectations for GAAP earnings per share in 2024, and about 26 times what they have penciled in for 2025. And of course, again, along the way, the consensus estimate, including our estimate, is free cash flow does not return to positive territory until maybe 2026, maybe 2027. And at that point, 2026, 2027 is when we actually see this next slump coming. Because remember, semiconductors are cyclical. It's a manufacturing-based industry. We're going to get a nice spat of growth the next couple of years, but then 2026, 2027, we're headed for another slump. That's what we have penciled in on our estimate. We'll expand on this at the end of the video, but yeah, like you said, Intel just doesn't meet our criteria. But let's talk about what does meet our investment criteria. Lam Research, let's do a follow-up on that. Well, we did a video, sort of a pre-earnings video a couple of weeks ago. What happened with Lam?
Yeah, let's talk about Lam. Q2 2024 results. And we were a little off on this one. I think we said this was going to be another down quarter, that they would report even more losses. But actually, the numbers were a bit better than we expected.
We didn't get a 20% pullback, but for the record, that was like my wishful thinking and not your guess.
No, we did not get that pullback, but we still, I think both of us really like this company. So let's talk about their most recent quarter by the numbers. You can see revenue increased to $3.6 billion, up 8% quarter over quarter, down 29% year over year. Gross margin 46.8%. Earnings per share $7.22, down 33% year over year. Free cash flow at $1.34 billion, which is up 37% year over year. Nick, what do these numbers tell us? What do you think?
The bottom of the memory chip market is in the rearview mirror. The year over year numbers are still down for Lam, but on a sequential basis, the rally has taken hold. And so we're now all eyeing what's the trajectory for this business through 2026. Again, the next upcycle for chips is here. Lam Research really is starting to look exceptionally well positioned for growth for the next 2 years. So as we talked about in our last video on Lam, this has kind of become our favorite stock of the Fab 5 since the end of last year. We finally took our initial position in Lam, and yeah, no pullback, but this is one at some point that I think, Casey, you and I were just going to have to hold our nose on the valuation at some point and buy, because that valuation really is kind of being skewed by the year over year trailing 12-month figures. But on a forward-looking basis, the stock is looking increasingly pretty well valued. Just kind of rounding this out here, again, like on our last video, we talked about the systems revenue, the sale of equipment is of course down, but you can see the customer support related revenue, again, skewing to Lam's favor as they help customers like Micron shuffle equipment around, the existing equipment that they have, moving it into the fabs to meet what product demand they're facing. Ultimately, like those new equipment purchases are just being delayed. It's going to happen. Fiscal year 2025, which starts in June of 2024 for Lam, could be a big, big year for this company. Also of note, the balance sheet suddenly looks really, really good again because of the free cash flow making a big jump. Cash and short-term investments, $5.6 billion, about a $400 million quarter-over-quarter sequential increase. Total debt of just shy of $5 billion. It's a pretty good balance sheet for a big, mature equipment producer like Lam.
One point that I really liked on the earnings call is that Lam Research has doubled their earnings per share since the last semiconductor cycle trough in 2019. And CEO Timothy Archer had three good reasons why that is. The first is they have improved the position outside of memory into foundry, logic, and specialty technology segments. Our last video, we mentioned in one quarterly report last year, their memory market was up to 2/3 of their revenue. You can see that it's down now to 48% this quarter, but they're diversifying away from only the memory chip market, which is, of course, very cyclical. The second is they've delivered on that customer support group. That is becoming a higher source of revenue for Lam Research. And then third, they're very good at managing their finances, as Nick said. Very solid reasons as to why Lam Research has been able to weather this semiconductor downturn.
Another point that I like that you picked out from this, Casey, was an analyst on the earnings call asked about ASML. Of course, the high NA EUV lithography machine getting delivered to Intel first, but Samsung's going to get one. TSMC's eventually going to get one. What does that mean for Lam Research, if anything? Lithography is a completely different type of equipment, right?
Yes, that was a brilliant response, Nick, that the CFO had when asked about that, because he said you never buy litho without eventually buying the process equipment that goes with it. So if they're seeing something, we will see it too. That's brilliant because all of these orders that are coming in from ASML, it's not a standalone piece of equipment. You have to have other items that go along with it. And that's why Lam Research can benefit from these sales as well, eventually.
Yeah, absolutely. Lam Research, one of the market leaders in deposition and etch. So you expose the wafer with the lithography machine, but then what? That's a cool process, an amazing technological marvel, but it's worthless without the steps that come after it. So yes, of course, Lam Research going to be a big beneficiary from that. Should we talk about valuation, even though this is kind of a weird one?
So March 2024 quarter guidance, you can see the slide here, 3.7 billion in revenue, plus or minus a few hundred million, 48% non-GAAP gross margin, and 29.5% non-GAAP operating margin, $7.25 plus or minus 75 cents for earnings per share. So where does that put us for the valuation, Nick?
Yeah. So another sequential increase in revenue expected, another sequential increase in rising profits again. Bear in mind the year-over-year growth rates are going to be negative, but again, sequential growth. And remember, Intel not turning a profit during this downturn. Big, giant, crucially important chip maker. It's a mature business, not turning a profit. Lam Research is one of those easier investments, we believe, for us, for like what we look for in a long-term investment into a great business. This meets the criteria because even in this downturn, they remained profitable by all counts. And now through 2026, fiscal 2026, it looks like Lam is going to be hitting eventually at some point new record sales and new record profit margins. And of course, they plow all that excess cash into the dividend and stock buybacks. So on a valuation basis, yes, on a trailing 12-month basis, it looks ugly, over 30 times trailing 12-month earnings. But on a 1-year forward basis, we're looking at like probably, let's just provide a range. I think 20 to 25 1-year forward earnings based on our estimates. A lot of that's going to have to do with the memory market and its cadence of rebound and rally and how much equipment Micron will eventually need headed into the next fiscal year. But if we're looking at this over the course of the next 2 to 3 years for the duration of this next growth cycle for the semiconductor industry, Lam looks pretty attractively priced at these levels to us.
Okay, let's talk about another company in our wafer fab manufacturing Fab 5, KLA Corp. This company specializes in metrology equipment, measuring stuff, measuring semiconductor stuff, to keep it simple. After earnings, what are our takeaways from this company, Nick?
Yeah, this is another one that is still reporting year over year declines. Let's use a chart from our friends at Main Street Data to show this. You can see a bit of sequential recovery, but still by and large, year over year declines. So the prop up they were getting in the last year from the more mature manufacturing, automotive and industrial chips, kind of like Applied Materials was getting, that's now gone. And they're now actually in year over year decline. And in addition to this is one area worth monitoring closely. KLA, the metrology market, actually has, we think, elevated competition, whereas a lot of the other areas of the Fab 5, obviously lithography, dominated by ASML, not a monopoly, but close to it, definitely a monopoly in EUV specific. Applied Materials, dominant player in what it does. Lam Research, a dominant player. Tokyo Electron. KLA has these competitors like Onto Innovation, which we invested in almost a year ago now for the first time, as well as Nova and Camtech in Israel and some other players. So it'll be interesting to see how this metrology space settles out as chip manufacturing gets more complex. The metrology equipment and process control and diagnostic equipment becomes increasingly more critical because you need that to make sure that your new manufacturing process is going to be yields that maximizes profitability for the chip maker. So it's going to be a secular growth trend, but we worry that maybe KLA isn't going to experience the most growth out there. We think Onto Innovation and some of the other smaller metrology players could pick up market share in the coming years. At any rate, should we do the high level numbers real quick?
Let's do it. Revenue decreased 16% year over year to nearly 2.5 billion. Earnings per share decreased 38% year over year to $4.28. On an adjusted basis, earnings per share decreased 17% year over year to $6.16. Free cash flow decreased 8% year over year to $545 million. And as far as the balance sheet goes, cash and short-term investments of $3.34 billion, total debt of $5.14 billion.
So as far as sales go, you can see here from the chart they provide semiconductor process control making up the bulk of revenue. Specialty process, printed circuit board and displays, a smaller bit. The reason why we went with Onto almost a year ago, Onto Innovation, is a sharper focus on some of those more advanced and specialty semiconductor processes. You're going to get a more cyclical business because of that, but we think more growth over the coming years. We'll circle back to this topic later on. So by and large, Casey, they were reporting some nice sequential growth in recent quarters, but now all of a sudden it looks like maybe they haven't quite hit bottom again. They did have a big customer push out an order for advanced manufacturing into next year. So for the next quarter, the March quarter, 2.3 billion is the expectation for revenue, a slight sequential decrease. We bought KLA Corp last year just because we wanted an initial position in metrology. Onto is actually, I think, our bigger position at this point when we subsequently bought it. And then, of course, the stock rocketing higher last year. At what point does this go back on our buy list? Are we buying it now? What's your take on this?
Well, no, we're not buying it right now. We've decided that we're just going to watch and kind of see how things go over the course of the next couple quarters. Management really hasn't given us a clear picture into the upcoming year. And so we just feel like it's better to just wait and see on this one. I think we still both like Onto Innovation. We'll have to see what they report, but I think that's our choice right now in metrology.
Yeah, maybe one positive though, because this is maybe we're painting a gloomy picture here, and that's not what we're trying to do because it looks like March could be the low point. So that's good news. Uh, so, yeah, like you said, we're waiting. We do cover the stock a lot though, and I think there's value in it because a certain type of investor we think should be drawn to a business like KLA, right?
Yeah, dividend investors, right? This company does a lot with stock repurchases, and it could be another big year for that in 2024, right?
The outlook was maybe framed as a little uncertain, but obviously management thinks the next growth cycle is sooner than later. Quite a bit in stock repurchased in the last quarter. 438 million in stock repurchased in Q4 calendar year 2023. Actually a 23% increase year over year in stock buybacks. So that's good stuff. And then of course KLA, we think this thing is not going to be again the highest growth stock of the Fab 5. We're thinking maybe a 20% increase in revenue from peak to peak, the last peak being June 2023 fiscal year for KLA to maybe the June 2026 end of fiscal year. So maybe just 20% revenue growth over a 3-year stretch from peak to peak for KLA. But if you're a dividend stock investor, that's not your biggest concern here. What you're looking for is profit margin increases and what the company does with its influx of cash. And historically, the company, again, increases its dividend, makes strategic repurchases of its stock. So we think this could be a nice, solid, slower growth, but free cash flow per share growth stock in the next 2 to 3 years.
And one final note on the positive side for KLA, and we haven't talked about this in a while, but regarding the global interest in chip chain resilience or supply chain resilience, that onshoring and friendshoring of chip manufacturing is going to become a bigger deal, possibly for KLA Corp all the way through 2026.
Yeah, and this is maybe where we'll close out the video. I alluded to at the beginning that we would talk about this. And please, everybody, keep this in mind as you invest in semiconductor stocks over the course of the 2020s, because we do think this is a long-term risk. So all of that friendshoring and onshoring going to benefit the semiconductor manufacturing equipment companies, critical choke point in the semiconductor industry flow. Our worry is, so we have the next down cycle penciled in at, say, 2026, end of 2026 through 2027, maybe even into 2028. I don't know. And then another spate of growth to 2030, which by then everybody is looking at as being the $1 trillion per year in end market sales of chips. Okay. Roughly a double from where they were at in 2023 to 1 trillion in 2030. Along the way, we think there's going to be excessive manufacturing capacity built out in the US, in Asia, in Europe, because everybody wants the supply chain resilience, which is a good thing for the ultra long term. But at some point, there's going to be fallout from this, we think. Over the last couple of years during the bear market, you've probably seen this. What happens to your profit margins when you have too much manufacturing capacity not being used? Your profit margins take a hit. So just kind of keep that in the back of your mind during this, let's say, semiconductor fuel bull market of the 2020s, that at some point this is just our viewpoint. We think there's going to be some fallout from all of this excessive focus on building manufacturing resilience. The pendulum always swings in the investment universe. It doesn't matter what you're investing in, but we always go from crisis to crisis, with the aftermath of one crisis leading into the reasons for the next one. from bull market to bear market to bull market. So just keep that in the back of your mind. We think some great years ahead for the Fab 5 and for the market, for the semiconductor market overall. But too much manufacturing capacity could come back to bite us at the end of this decade.
I think what you just said doesn't only apply to the semiconductor market, but to the human race, doesn't it? We all go from one crisis to the next.
We're good at that.
All right, that's a wrap for our review here for Intel, Lam Research, and KLA Corp. Make sure you hit us up with comments, questions, anything you have on your mind that you want us to cover, or maybe some questions about this video. If you have not already, make sure you hit that subscribe button and have notifications turned on for community posts. And just as a reminder, we do have a membership option as well. Now, you can purchase that here on YouTube or over on our Ko-fi page, whichever you prefer. It's about $5 a month, and it gets you some fun emojis, your own personal little badge, and most importantly, probably to everyone, is access to our Discord channel, where we will continue to release all of our show notes, our published manuals, and we'll chat on Discord. If you're not into a monthly membership, which we totally understand, you can always buy our show notes or manuals over on Ko-fi a la carte there on our shop page. So check that out as well. And we appreciate all of our viewers and friends here at Chipstock Investor.